Hi, this video is about balance sheets, how they're put together and what they are used for. Balance sheets are financial statements that are used to evaluate the financial position of a company at a specific point of time. So you would see on top the name of the company, the type of the financial statement, in this case a balance sheet, and the date at which it was put together. A balance sheet will always be divided into two halves and will always contain three elements. First of all, the assets on the left-hand side, next liabilities on the right-hand side, and the third element, owner's equity, also on the right-hand side below the liabilities. You will also see in each of the column a total, so the total of the assets and a total of all the liabilities plus owner's equity. Some notes may accompany a balance sheet that will give relevant information about the entries in each of these categories. So what we'll do in this video is that we will discuss each of these elements separately, and then we will consider a fictitious company and we'll put together its balance sheet and we will evaluate the financial position of that fictitious company. So let's get started. So first of all, assets. Assets are the economic resources of the company. They may be in physical form, such as land, buildings, supplies, equipment, or in intangible form, such as legal claims or rights. And they are always listed from the most liquid, such as cash, to the least solvent, meaning here not easily converted into cash, for example, land or buildings. One very important fact about assets in balance sheet is that they are listed at cost, meaning at the historical cost at which they were purchased. So say a company had purchased a piece of land for $100,000 10 years ago. Today, this same piece of land is worth $250,000. In the balance sheet written today, it will still be listed at $100,000, and that is to maintain objectivity and factual and accurate data. So now the second element of a balance sheet, liabilities. Liabilities are nothing else but the debts of the company. And each type of debt is listed separately. So you would see accounts payable, and these happen whenever a company purchases items, supplies, or equipment, or even services on account, meaning the service is rendered or the equipment delivered, but the payment is to be made at a future date. Notes payable are a more formal type of liability. These are the loans that the company has taken, and they usually involve a written agreement and interest. And you may also see income tax payable, and this is the tax that the company owes the government. And now the third and final element of a balance sheet, owner's equity. Owner's equity is the claim of the owners over the assets of the business. It is displayed differently depending on the type of the business. So first, let's write down the three types of business organization. Corporations, which are legal entities separate from the owners, where the owners are not personally responsible for the debts of the business. Sole proprietorships are typical of small businesses, where the owner is usually the manager, and in a sole proprietorship, the owner is personally responsible for the debts of the business, even though the assets of the owner are not listed in the balance sheet or in the financial statements of the business. And partnerships, the third type of business organization, partnerships, similar to sole proprietorships, except that there is more than one owner. In sole proprietorships and partnerships, owner's equity is listed in a similar fashion, so we will discuss them together. And now we'll go back to corporations. In a corporation, whenever the owners invest in the business, they are issued shares of capital stock, and consequently, the owners are called stockholders. And the owner's equity is nothing else but the stockholder's equity. And stockholder equity consists of two elements. One is the capital stock, which is the amount invested in the company by the owners. And two, retained earnings. Retained earnings, which is the amount accumulated through profitable business that has not been distributed back to the owners as dividends. Now, in a sole proprietorship and a partnership, there is no distinction between capital stock and retained earning. And consequently, there is only one entry per partner or per owner, and that is owner's name and the respective amount of capital invested. So there will be only one entry in a sole proprietorship, and there will be one entry for each of the partners in a partnership. Now, one important fact about owner's equity is that it is a residual amount, meaning liabilities take precedence over owner's equity, or creditors have priority over the owners. Any debts of the business have to be paid in full before the owners can cash any of the assets. So by definition, owner's equity is equal to the assets minus the liabilities. And that brings us to the very important equation that governs the balance sheet. Assets equals liabilities plus owner's equity. And this is the governing equation of a balance sheet. It is always true, and if not, that means that either something is wrong in the data or in the way it has been categorized. And this is the essence of why a balance sheet is called a balance sheet, because both sides of the balance sheets are balanced. So now that we've learned what a balance sheet is, let's try and put one together for a fictitious company. So you're the accountant and you've been given this information and you've been asked to analyze the financial position of the company. So you would first start by putting together the balance sheet. So let's get started by writing down first the name of the company, say XYZ company, the type of the financial statement, so in this case a balance sheet, and the date, we're in July 2016. So right away you can go ahead and divide the sheet into two halves, and let's put down the different elements of the balance sheet. So assets on the left hand side, on the right hand side we've got both liabilities, and since this is a corporation, stockholders equity. So let's start with the accounts payable. These are a form of liability. The company must have purchased items on account. Accounts receivable, on the other hand, is a form of assets. It is expecting to receive this amount of money. Buildings, another form of assets. Capital stock, the amount invested by the stockholders. Cash, the most liquid form of assets, so it goes on top. Equipment, another form of assets. Income tax, a liability. Land, another form of assets. Notes payable, that is a debt, so a liability. And retained earnings go in stockholders' equity. So now we can put down the totals. So let's see, for the assets, 70, 60, 130, $198,000 for a total of the assets. Liabilities here are amount to $48,000, and stockholders' equity, $150,000. So a total for liabilities and stockholders' equity of $198,000. And we've done a great job. As we can see, the balance sheet is balanced. The assets is equal to the total of liabilities and stockholders' equity. So now we can go ahead and look at the position of the company. So say you're a creditor and you've been asked whether you're going to give this company a loan. So what you would first do is look at the liabilities, and as you can see here, it has a total amount of liabilities of $48,000. Looking at the assets, at the most liquid assets, cash and accounts receivable only amount to $11,000. You cannot consider here buildings, equipment, and land, as these are not solvent. So $11,000 compared to $48,000, the company is really in a weak position, and you would be very reluctant to give this company a loan. So this is how you would analyze a balance sheet. And To recap, we've learned in this video what a balance sheet is, how it is put together, what are the three different elements: assets, which are the economic resources of the company; liabilities, the debts of the company; and stockholders' equity or owners' equity, the claim of the owners over the company's assets. And of course, the governing equation of balance sheet, and that is assets equals liabilities plus owner's equity. I hope that you've enjoyed this video and that you've learned a lot from it. Goodbye.